Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And I feel like this show has a pretty patriotic theme, at least in the first half, when you think of America 250, Trump accounts, and the World Cup.
Yeah, the World Cup. Everyone's tired from watching the World Cup yesterday, and they're going to be tired again tomorrow. Yeah, because the USA is playing.
We have to gear up for a big game tonight. But let's get to the biggest stories right now in the nearly $22 trillion global ETF industry. President Donald Trump rang the opening bell for the New York Stock Exchange and the Nasdaq from the Oval Office on Monday, marking the launch of Trump Accounts. It's an investment vehicle for American children.
All contributions to the accounts will initially be invested in one single fund, the State Street Spider Portfolio S&P 500 ETF, SPYM. State Street Investment Management's Anna Paglia will be joining us in just a moment.
And then later on in the show, the avalanche of new leverage ETFs and other innovative products has the SEC considering a rule change for filings. We're going to break that down as leverage ETFs make up about a third of all new launches. All of that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now, and he's looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So, again, I'm going to report a lot of the same. The flows are very robust. We look at the leaderboard. SPYM, by the way, speak of the devil, at the top here. VU had some rebalancing issues, so it kind of took the week off. But look for SPYM and VU to be in a real fight for flows over the next, months and even years. DRAM number 2, that's that memory theme ETF that's just insane, right? It took in so much money for a theme ETF, only 4 months old. It's up here rubbing elbows with the big guys. RSP equal weighting, why is that interesting? Well, the Mag 7 hasn't done that well this year. It's the 493 that have outperformed, so no shocker to see some money go in there. And then some semis and some total market. Let's look at the outflows. You can see a ton out of SPY. This could be some of that rebalancing. June had a lot of rebalancing going on. So some of this is money that came in and then came right out. What I want to focus, though, is that net number, especially for the month of June, okay? June was ridiculous. I'm going to call it June sanity because I didn't really notice it, but the flows were unbelievable. $9 billion a day went into ETFs for a total of just about 200, making it the second best month ever, believe it or not. But check this out. The launches were unbelievable. We had 214 launches. That's 10 a day, normally 4 a day. And we had 7 trillion in volume. That is the second most ever. So again, Katie, just breakneck pace across the board in all the big metrics for ETFs.
Absolutely. June sanity. We'll see what name we come up with for July. Eric, thank you. Let's keep the conversation going with Anna Paglia. She is Executive Vice President and Chief Business Officer over at State Street, joining us on set. Anna, fantastic to see you.
Thank you for having me. Always good to see you.
So let's start with the big news, of course, and that is SPYM. You were tapped by the Treasury Department to be the default fund option for Trump accounts. There will be other accounts that are added, but until then, it is SPYM that is in the hot seat here. So talk to us a little bit about how this came together. You think about SPYM, the expense ratio of just 2 basis points. I have to imagine that helped, but talk us through, how actually we ended up here.
Well, the process has been really simple because it is a program administered by the Treasury. And by statute, there are some limitations to which funds can be a part of the program. Funds have to have a total expense ratio of less than 10 basis points. They have to give access to some of the widest and best known indices, broad market-based indices that give access to the US economy. So SPYM, I had to say it was the obvious choice, but it was the obvious choice because it is one of the best-selling ETFs with over $40 billion of net new assets this year alone. The expense ratio is 2 basis points, which makes it the cheapest access to the S&P 500, and the spreads have been incredibly compelling, so it was the perfect candidate for this program.
It sounds like because the fee is 2 basis points and that is lower than VU or IVV, that's why SPYM won out. Is that fair to say?
Well, I think many things have contributed to that. The fees, the flows, obviously there is not one single reason, but if you look also at how the Treasury has characterized the choice, it's really based on the fact that it meets the parameters of the statute.
This ETF is interesting to me. SPYM, people don't know, had a whole makeover. Back in the day, it was SPLG. I think it tracked the Morningstar index, charged a little more, and nobody cared. So they changed the index to the mighty S&P 500, cut the fee to 2 bips, and look out. So SPYM was on a roll before this. And I wonder, when you're inside State Street and you saw VU overpass SPY, was it like Michael Jordan? And I took that personally. And you basically are now making SPYM go out and avenge the death of SPY. And VU is right in your crosshairs. Do I have that about right?
Well, Eric, it's right-ish. I'm waiting for you to change your tagline into SPYM and chill. So I'm waiting for that. Hopefully it's coming soon. But I would say that SPYM was the complement to SPY. We don't look at SPY and SPYM as 2 separate products. We look at SPY and SPYM as 2 different parts of our S&P 500 offering. And our strategy is working. SPY is still the most traded security in the industry. And SPYM is the fastest growing new ETF, new-ish ETF, because of the combination of exposure and low fees.
Yeah, it's been fascinating to see, coming out of that sort of makeover, just assets sort of hockey stick there. I do want to talk a little bit about the mechanics of Trump accounts, because if you take a look at the statement from the Treasury issued last week, they talk about how in the coming months, Treasury expects to make available functionality that will allow parents or guardians to choose how to allocate funds across additional investment options, talking about those alternate funds. And then in relation specifically to SPYM, until that functionality is available, all contributions will remain invested in the default fund, which is SPYM. So what does functionality mean in this context, and what does sort of the wiring look like to get this up and running?
Yeah, so I think that Treasury is doing the right thing, which is a new program. It's going to have a high volume of users and assets going into the program, which means not all the answers are going to be available on day one. So on day one, we are going to see Robinhood transition the initial flows into SPYM. People are downloading the app. I'm signing up my kids today. Luke and JJ, they are going to have access to a segment of the American economy with SPYM. And once the app is going to be downloaded, and the contributions and the matching contributions are also going to be plugged into the program, this is where we are going to see an evolution of the technology. So I think that in the walk, crawl, run, I think is the right order, or crawl, walk, run. I think that Treasury is taking the necessary steps to make sure that the deployment of the program is successful.
Internally, what are you forecasting in terms of how long SPYM will be the default investment vehicle before other options are available? Does this look like something that's more akin to 3 months, or something that looks more like 3 years?
Well, that we don't know, and I think that right now it's impossible to predict. I think it's going to be at least a few months, but we haven't been given any signal or any indication of how long this interim phase is going to be.
So I just want to give a real broad perspective here. 55% of Americans currently own stocks, and obviously the top 1% owns half the stock market. That is a big number, especially the 58. Other countries, it's like 40, 30, it goes right down. Like, we're unusual in America owning so much stock. This is going to bring most of the rest into the stock market. So we're going to have like most Americans owning stocks. How is this going to change maybe the complexion of the stock market? Are we socializing the stock market to the point where it's our new Social Security?
Well, this is a really good question, because I think education is going to play a critical role in that. The fact that we are expanding the possibility to own a segment of the U.S. economy to kids is revolutionary, is transformative, because right now it's not just an access point. We look at the Trump accounts as a change in investor behavior. This is a program that allows you to become an investor from birth. So your journey doesn't start when you are 18. I made my first investment when I was in my 30s. So I love the fact that now you can own a piece of the economy at birth. That's part of the journey that was overlooked, and is now going to become part of your investment profile, your investment strategies.
Yeah, no, it makes a lot of sense. It will probably go a long way to curbing the wealth gap for sure. I think one of the things that I'm also looking for is philanthropists. Michael Dell has contributed money. There's been a couple other people who've stepped up. it seems like a real clean, easy, tax-efficient way because the money goes right to the person who needs it. There's no in-between people, and it grows. Do you sense we'll see other big philanthropists step up and maybe even try to help some of the kids who were recently born but might have missed the cutoff?
I hope this is going to be the case. Because, again, if you look at the fundamentals, if you look at the value proposition and the reason why this program was established, it was to democratize access to financial markets to those people who need it the most. So the Dell Foundation is making a decision about the zip codes that are most at need of financial exposure. This is going to change dramatically the way by which U.S. investors will access the markets.
And Anna, so we're talking about Trump accounts, obviously a big win there when it comes to SPYM being the default fund. You've also had big news in recent weeks when it comes to what's going on with the Nasdaq 100. You launched QNDX. This is the State Street SPYDR portfolio Nasdaq 100 ETF. Previously, Invesco has sort of exclusively controlled pure Nasdaq 100 ETFs in the U.S. market. That has now changed. BlackRock also has a filing for such a fund, but you beat them to the punch here, launching in late June. And so it's just interesting. I mean, you think about these two separate news items, you combine them together, and it seems like State Street, the stars are sort of aligning here. And you think about your firm's position in the ETF industry, your share, even though you're number 3, has been slipping for the last few years here. And I wonder, whether you see that trend now reversing when you think about, all these different sort of stars aligning.
Yes, stars are aligning. This is a good way to put it, but stars don't align by accident. This is all part of a lot of good work done by a lot of really good people within State Street. I think a market share may be a little misleading because the market is growing, and it is easy to be the top 3 in a market of 5. It's not that easy to be the top 3 in a market of hundreds of new players.
And growing, yeah.
And growing. So the decline in market share is not really surprising. We are not the only ones in the top 3 losing a market share. But you have to look at the flows and the continuous growth of our business, which has been phenomenal. QNDX, the addition of QNDX is also something that we find incredibly exciting because today we are the only firm that offers access to the big 3. The Nasdaq 100, the S&P 500, and the Dow Jones Industrial Average. So for us, it's really about putting those options in front of our clients and seeing how they are received. QNDX has been great. We were out of seed on day 1. And we had positive flows every year, every day, with the exception of one day, which brings this launch to be one of our most successful fund launches.
All right, Anna, that's a good place to leave it. Great to see you. Thank you for stopping by the set. That is Anna Paglia of State Street Investment Management. Now, coming up, we're going to tell you about some of the latest ETFs to launch. Corgi funds coming in hot with a whole new batch. Meanwhile, you have the SEC considering a rule change to ETF filings. We're going to tell you why that could be critical. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu. Let's get to the ETF life cycle, where we walk you through the 3 main stages of ETFs, from initial filings to final farewells. Step 1 is the filing. BlackRock submitting paperwork for an iShares Future AI Beneficiaries ETF. No ticker yet. The fund will look to hold stocks expected to amplify revenue or reduce costs within the next 5 years through the adoption of AI. This is one in a very, very long list of ETF filings tied to the AI build-out. Step 2 is the launch. Corgi Funds is at it again. The startup launching another swath of ETFs, including 31 single-stock 2x ETFs late last month. They cover names ranging from Archer Aviation and ARM Holdings to GameStop. And for some, the final stage is farewell. Guinness Atkinson shutting down 3 funds: SOLR, which focused on sustainable energy; GAUD, which sought out U.S. dividend growers; and GAID, which basically did the same with international dividend growers. And that, Katie, is this week's Life Cycle.
Well, speaking of filing, Bloomberg News reporting that the SEC is giving a rethink on how they oversee ETF filings. And Eric Balchunas, you spoke with someone from the SEC on your podcast.
Yeah, we got I'll call it an exclusive. Is that okay?
Yes,
yeah,
you can.
I don't do many of those, but yeah, I think we wanted to dig in. It's like a 50-minute long interview, and it's great because the SEC doesn't like talk that much, you know, and so we got into all kinds of topics. Two things that stood out were, one, they're definitely pro-innovation, and two, I think a lot of this is just about the volume they're getting. They get 2,600 ETF filings a year, and I think there's just not enough people, so they want to create some order to this. And we have a clip that we're going to play here of Brian Daly, who heads up the investment management division, what he had to say that we can look at now.
The prediction market ETFs coming in were, in a sense, a catalyst because they're a different structure. They're focused or they're tied to an underlying that we have a sister regulator that's looking at very closely at the moment. They're working out the regulatory scheme for that area. And it really just, you know, it just crystallized that we have come so far in 7 years. This is a dramatically different world.
Yeah, so look, what he just said there was that the prediction market ETFs were kind of like a moment where they're like, wait a second, if we approve these, we're going to get 500 filings in like a couple days. And then he goes, and then there could be ETFs tracking perps after that. And then he says, quote, and who knows what else after that? And you know what he means. So that's a big part of what I think he's talking about here. And Isabel, you reported on this. You interviewed him, probably the more accurate use of the word exclusive. What did you learn?
No, you also got an exclusive. We can both get an exclusive. So basically, we had a chat with Brian after he did a podcast with Eric. I literally picked him up from the podcast room. And then they released this request for comment, and it basically asks for two things. Number one is to give issuers greater confidentiality when they file. Katie and I know this. We have a group chat where we paste every single ETF filing. And honestly, sometimes when you see one unique one, minutes after, you see another one. And it's kind of amazing to see. And I guess that's what they're thinking of trying to avoid, because it really is, like Brian Daly said, it's a ferocious copycat race. And the second one is whether they should have additional tools in their toolbox to really intervene after a fund launches, because now they only have suspension, which they said is a little bit extreme, and you don't want to just suspend right and left.
So the one thing I think people may not fully understand is that when an ETF issuer files paperwork, it's not like the SEC formally accepts it or rejects it, right?
Yes.
They just kind of look at the paperwork, and sometimes things can go off without and just launch regardless.
Generally, it launches after 75 days. We always go to the Bloomberg intelligence guys, Eric, James, and Athanasius, and we're like, is this already a green light? And they're like, no comment basically means it's good news. And basically it means it's effective. I mean, just because a fund is effective doesn't mean it can launch. It's up to the issuer to decide when they want the ETF to debut. But it's a little tricky thing that if you don't cover the space closely, you're like, what is going on?
We only have like 30 seconds here, but also in this sort of rethink is the SEC questioning whether or not, you know, these filings should be confidential, which I think is really interesting because it sort of goes against the ethos of the ETF industry, where transparency is really prized. And I wonder what you make of that, the idea that these filings, which we all scour, could actually be sort of hidden away.
Yeah, I don't love it because I love looking at the new filings, but I get it because I think the SEC is getting complaints from the issuers like, hey, we'll follow what you tell us, we'll be good actors, but don't let me get like leapfrogged by a bad actor. Confidential filings, I think, would solve that.
There's also the first in, first out thing, right? Like if you file first, you launch first. It's an interesting space to watch. In
Yeah, but then they
60
just
days,
do
we'll
name
know.
changes now, and it's
They do.
really
They do.
crazy.
I love it. That's what
Isabel.
ETF IQ is.
Thank you so much, Isabel Lee, again, with the story about the SEC considering new ETF rules as this boom disrupts the status quo. A reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the industry. And Joel, of course, will be joining us at the end of the hour for our new segment, IQ Test. You can see just how smart you really are. Now, still ahead, ESG and sustainable funds are looking for an atomic boost with a surge of exposure to nuclear arms production. That's next. Should ESG and sustainable investing include nuclear energy? Funds positions in stocks excluded by Norges Bank over nuclear arms production have risen 95% since June of 2025. And this increase in exposure was likely aided by EU guidance last year that left out nuclear arms from its controversial weapons definition. Joining us now for more is Shaheen Contractor of Bloomberg Intelligence. So Shaheen, just take a step back here and talk to us about ESG funds and nuclear arms production overall.
Sure. So, as you mentioned, the exposures have increased 95%. I think while many people think this was really after 2022 when Russia invaded Ukraine, when defense became this shiny object, that really isn't the case. It was really since last year with this EU definition change.
Yeah, I want to talk about this definition change and moving the goalpost because I'm hearing on the streets that ESG has a new name.
What streets are you on?
The mean streets of Philadelphia, or actually the fourth floor. ESG now stands for energy, security, and guns. Are you hearing the same? I mean, I do know that there's a lot of rebranding going on. I hear now it's called sustainable finance. Like, it seems a little lost, to be honest with you. What's going to happen?
I think the acronym you mentioned, the person on the street that told you was maybe half joking. But
she told me, by the way. But she told me not to tell that she told me.
Half joking. But at the same time, yes. So I think when it comes to defense as a whole, the whole EU shift has really fueled this. And it's not all defense. It's very specifically nuclear weapons, getting out of controversial weapons. So yes, I mean, for the lack of a better acronym, it adds fuel to the fire.
There you go. And it just feels like, when it comes to nuclear stocks, it really showcases how the E, the S, the G can sort of be in conflict with each other. That, okay, maybe E is satisfied, but maybe it doesn't align with your S values.
So it's really interesting because the EU has this do no significant harm rule as part of its fund mandates, which means that you cannot meet or you cannot claim to meet one environmental or social objective when you're damaging another. And this just convolutes this whole thing.
It's a rapidly evolving space, let's put it that way. And what ESG ends up standing for down the road is, I guess, kind of up for debate. Shaheen, thank you so much. Shaheen Contractor of Bloomberg Intelligence, and you can check out Shaheen's research on your Bloomberg terminal by typing BIGO. Katie?
Coming up, we're going to drill down into a fund assuming market behavior over the next 10 years will be fundamentally different than the last 40 years with Neil Howe of Hedgeye Asset Management. That conversation up next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. Eric, take it away.
Katie, today we're looking at the fourth turning ETF. Hedgeye is the issuer. Heft is the ticker. It's pretty new, came out just at the end of last year. Okay, what does this do? It is an actively managed cross asset, so it can go in any asset class, invest in other ETFs. And it's basically on this theory of the fourth turning, a generational theory about how every 100 years there's these cycles and how the next 10 years won't look like the last 40. That's the idea. We'll get into that with the guest. You can see it's got 70 basis points of a fee, very new, 92 million, pretty good for a new active fund. Let's look at the holdings, and you'll see it's a bunch of ETFs. I give this manager credit because these are not the most obvious ETFs. Like FM is a very specific issuer. Vanguard, we see that a lot. DBMF, that's a managed futures, and you got Noble. Somebody clearly went through and picked out exactly what they wanted. Now, how this all fits together, we'll talk about in a minute because it's all across different asset classes. The returns here, I put against SPY and AG. And you can see here, it's kind of in between. So it's up 5%, SPY's up 15%, AG's up 0.85. So the key here, Katie, will to be explained why you need it. Again, when it's not as good as the market, but maybe it's better than bonds. We'll see what happens.
Well, thank you, Eric. Joining us to talk about this ETF, I'm thrilled to say, is Neil Howe. He is a demographer who co-manages this fund. He's also the author of The Fourth Turning is Here. Neil, great to have you with us. I'm on the website right now looking at the overview of this ETF. So Heft's strategy is built on the premise that market dynamics from 2026 to 2036 will differ sharply from those of the past for decades. Zoom way out for us and tell us what you're seeing and, again, how this fits into this ETF.
Yeah, well, generally the premise is that the next 10 years are going to be very different. We've already seen these changes, the rate of change inflect over the last 10 years, right? We had a long period through much of the post-war era, particularly late in the post-war era, through the end of the Cold War, where the trend seemed to be toward disarmament, globalization, disinflation, deregulation. This is the Washington consensus. This is the, the deregulated world of the kind of the liberal future. Francis Fukuyama wrote about it in the end of history, right? Mm-hmm. But we think we're generally going the other way. We're going back toward a more, authoritarian leadership. You look around the big countries today, we're looking toward less focus on democracy, reinflation, re-regulation, industrial policy, even resource hoarding, and a growing spending, not disarmament, but rearmament, right? We've seen this trend before, and of course, this is a cyclically oriented perspective. This is a 10-year time horizon we're looking at for these funds. So obviously, some of these trends may be more or less, in the near term. For instance, disinflation, inflation, and of course, that's kind of what we have to do is sort of modulate it according to what's appropriate for right now. But the long-term trend is clear from that worldview.
Okay, so Neil, you're talking about a 10-year trend. How do you measure progress towards the goal? Are you asking people to hold off and look at what it looks like in 10 years to determine whether the fund achieved its goal?
Well, we obviously we want to achieve, best returns as possible every month, going forward. But it's very helpful to know what the goal is, right? What the overall long-term direction is. So that's sort of that's our lodestar. And in particular, we talk to a lot of investors who think that, valuations are extremely high, particularly in the United States markets, and there's a lot more downside than upside risk, right? And so what we want to provide is something where they are, very well protected on the downside risk, right? And so we take a lot of care to do that. We think this is a difficult, kind of fraught era for markets, coming up. And a lot of what we do is protect on the downside. I would say, if you're looking at three basic ideas that go into this fund, one is to take out the fixed income portion, which goes into a lot of people's portfolio, right? The 60-40 stuff, and replace that with commodity futures, with real return assets, with precious metals. We definitely think this is going to be a very bad next 10 years for fixed income, simply because of the long-term trend toward reinflation, and a lot of individual trends are pushing that. So we can talk about it. The next one is that within the equity portion, we're looking to go longer on what we call forth-turning themes. This would be defense, industrials, materials, and more of the production side of our economy rather than the discretionary consumption side, right? Or finance, or regulated utilities for that matter, which aren't going to do well in an inflationary environment long term. And then thirdly is to protect on the downside. So we have a pretty solid defensive core, and we also, we tend to have cash substitutes when the market valuations are high, which now is the case. And we also do a certain amount of downside, tail hedging with options to protect against the sudden downside risk. Plus we use a little bit managed futures as well to protect against more of the kind of grinding trend, either up or, particularly the down is what we're protecting on. So those are all the elements that go in. Downside protection, forward-turning themes and inflation protection.
Right.
Neil, I think where this gets tricky is that a lot of these ETFs are aimed at advisors, and they like to be the deciders. You know, as you said, 60-40 or whatever, they mix the pieces together. This almost seems like you're the advisors. Just put all your money in this, we have it all covered. That's a tough sell, though, or can you put it inside a 60-40 somewhere, and what do you sell to put it in?
Well, you could, but you're right. I mean, a lot of what we try to do is reach out to high net worth individuals and family offices, right, who make their own choices, right? I think also there are advisors who like to see, hey, this is something which may fit a certain kind of client, right? So, yeah, I mean, you could say this is sort of an investment advice all packed into one. I don't know, that doesn't bother me. Does it bother you, Eric? I don't know.
No, I mean, look, I just know that when asset allocation ETFs come out that like do it all for you, sometimes the advisors just don't want to have one ticker show up on the client statement because then they're like, well, what's my value? That's one of the things that some of these have to get over. But, you know, if the performance is there, you'll probably find some takers.
Yeah, I mean, look, there are a lot of different kinds of advisors, and these advisors have a lot of different kinds of clients, right? So there may be people who particularly like this kind of fund. We certainly get a lot of people who know about the stuff I've written, right? So they're kind of intrigued by that. It's a little bit of there's a little bit of a readership base here too, or a fan base. So I talk to a lot of these people. I do think that it's I do think though that when you have a view where different components work together, you like to give investors the full advantage of that, right? Rather than build a component which has no view. It's like, here's a tool, you go out to advisors. In other words, I could have been an investment advisor. Maybe that's what you're saying, Eric.
All right, Neil.
But instead I decided to start, we decided to start an ETF and maybe that is sort of one-stop shopping.
All right, Neil, great to have you with us. Really appreciate your time. That is Neil Howe. He is a demographer and the author of The Fourth Turning is Here. Now you can read about this drill down, plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. This is ETF IQ newsletter. There it is. Anyway, this is ETF IQ, the TV show. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And this week, the South Korean memory chip maker SK Hynix will make its American public market debut. Now you can see a leveraged ETF doubling the stock movement is outperforming other electronics funds and indexes, including the Philadelphia Semiconductor Index. So it's going to be interesting to see how that stock is embraced. Meanwhile, Robinhood is rolling out perpetual futures tied to commodities, ETFs, and currencies in Europe. Eligible European customers will be able to trade perpetual futures linked to assets including gold, silver, crude oil, and the euro-dollar exchange rate. Robinhood really aiming to capitalize on the rise in around-the-clock trading that's long been a feature of cryptocurrency markets. And speaking of crypto, I do want to end with Ethereum ETFs. They've been hit with more than $4 billion in outflows since the crash on October 10th. Now they're picking up slightly now after steadying in April and then falling again. Eric.
Thanks, Katie. eFund is China's largest fund manager, with its index investment team independently managing $111 billion. Sylvia Zhang is the assistant head of Global Index at eFund Management. She joins us now for more. I actually met you on my trip to China in October, which was very enlightening. China now the biggest country in ETF assets. What is behind the move there? Obviously, you got a lot of people there. How big are ETFs? What inning are we in? Give us a little lay of the land.
Pleasure to be here. And yes, I think China's onshore ETF market has experienced significant growth in the past, I should say, 5 to 7 years. And currently the total Chinese onshore ETF is close to 1.7 trillion RMB. So especially, I guess, starting in 2024, the AUM growth is kind of a phenomenon because surpassing the 40% on average, so on annual basis. So in terms of the product lineup, I think, there are bond-based ETFs, sector thematic ETFs, and now smart beta ETFs, the commodity ETF as well. So I guess it's one of the main driver of the market liquidity right now in Chinese mainland.
Give me a sense of the rate of growth and adoption between institutional investors and retail investors, individual investors. What does it look like?
I should say it's half and half. So previously, I think in the previous years, most investors, ETF investors, are institutional investors. However, I think starting several years before, the retail investors actually started to pick up, and especially, however, it's kind of different in terms of a different market cycle. Maybe in the market downturn, it's more about institutional investors. However, in recent years, especially I think since 2025, the retail investors actually really use the ETFs as a tool to do their asset allocation and chasing for alpha.
And so, as Eric mentioned, when it comes to the Chinese market, you're dominant when it comes to asset management overall, but also ETFs. Talk to us a little bit about what brings you to the U.S., to New York specifically, what you're hoping to accomplish and pick up on this trip.
So I think two reasons. The first reason is that because eFund is actually the largest asset manager in Chinese mainland, and currently I think globalization is one of our strategies. And second reason is that I do really want to introduce to a lot of investors, maybe in the United States, that I think it's currently right time or to look at the Chinese ETFs as part of your asset allocation.
So let me ask you a question about the mainland China investor. So my take, and again, I'm far away, is they generally kind of gamble more so. They go up with the good times and they leave when it's bad. Here we've got a bunch of people who voo and chill. They buy Vanguard and they never leave, and it works for them. Will we find that ever spreading in a place like mainland China, or will it be more so speculative investing?
I should say, yes, partly. I agree that a lot of investors in Chinese mainland are speculating the market and using the ETF, especially those granular niche ETFs, as a tool to chasing the alpha, especially the retail investors, because they are limited tools to invest in Chinese mainland, and whenever there's a structural growth on different specific sectors, they will it's kind of probably will become crowded at some time.
So that suggests that leverage products and options embedded products are pretty popular then. Complicated instruments to allow investors to do things that they wouldn't normally be able to do through very vanilla exposure.
Unfortunately, currently in Chinese onshore ETF market, the leverage and inverse and structured products are not allowed to launch or to list in Chinese mainland. So I guess the most retail investors nowadays, they are chasing the pure play, granular sector and thematic ETFs. So you can see that the data nowadays, the sector and thematic ETFs has surpassed the bond-based ETFs in mainland China, and probably 54% larger than the bond-based ETFs already.
That is amazing. The themes and sectors are bigger than all the other things there, probably because they don't have leverage. That's their one way to gamble and speculate.
You zero in.
It's like, it's hot. It's weak hot sauce, but it's as hot as you get there.
Yeah.
Until something changes. Sylvia, thank you so much for joining us today. Sylvia Zhang of eFund Management, normally in China, but in New York for the week.
Thank you so much.
Coming up on ETF IQ, it is time for an IQ test where Joel Weber puts our knowledge to the test. Here's a sneak peek at one of the questions. Small caps are having a banner year. What percentage of ETF assets are in them? Is it 2% or 12% or somewhere in between? Everyone said ooh, so we know that's a hard one. This is ETF IQ.
This is Bloomberg ETF IQ. I'm Katie Greifeld along with Scarlett Fu and Eric Balchunas. And it's time for an IQ test where Bloomberg's Joel Weber is going to see whether Scarlett, Eric, and I really know our stuff when it comes to ETFs. You know Joel is the co-host of the Trillions podcast with Eric, also as the head of games at Bloomberg. Joel, it's good to see you.
Great to be back. You know what happened last week?
It was amazing.
It was really good. And Eric called for a fact check. Eric, what happened when you did that fact check afterward?
What did we learn?
Okay, I was wrong.
Oh, you were? Oh.
It was like a challenge where I lose my timeout. So I was wrong. I admit it.
Okay.
Hey,
See?
All right.
man.
Humility is good.
Okay, let's see what happens this week. Your first question is, which market has the largest MSCI emerging market weighting? Is it A, Brazil, B, China, C, Taiwan, or D, South Korea? Scarlett.
I mean, once upon a time I know is B. I'm thinking it is D.
Katie?
I mean, I really want to pick B, but I'll say C.
Eric?
I mean, it has to be B. You're
Okay.
telling me South Korea is bigger than China now?
Let's see it.
I'll say B.
Okay.
Oh,
Wow. Isn't that amazing?
Thank you,
that feels
TSMC.
Eric's wrong again.
We'll fact check.
Yeah.
How is Taiwan bigger than
TSMC.
China?
Times
The island of Taiwan.
Times
TSMC.
changed.
Yeah, the times,
island.
they are changing.
Okay, scoreboard. Eric's down.
Oof.
Let's go to
That's the
question
important
2.
fact.
Yeah.
Question 2. According to South Korea's regulator, what percentage of investors in leveraged ETFs tied to the country's biggest chip makers are retail?
We actually know this.
Yeah,
Scarlett?
D.
Katie?
It's D.
It's got to be D.
Okay. It's actually even more than 90% according to them, but D
It's
is
90% plus.
correct. Yes, there you go. Okay, final question. Small caps are having a banner year. What percentage of ETF assets are in them? 12%, 8%, 4%, 2%?
I'm going to go with C because I feel like 2% is just way too minimal, way too negligible.
Yeah. The fun ends here because I have no idea. So I'm going to say B just to be slightly different
Okay.
from Scarlett.
Eric?
I think it's B or C. I'm going to go with C. I think it's really low, 4.
Okay, let's see what the answer is. You got one.
C.
You got one. Whew, bite your fingernails there.
know.
Yeah.
But was that a guess? I mean, that was process
little.
This
elimination.
is also
right?
Yeah.
way down, right? It's been
If it were
historically
8
higher.
or 2, I wouldn't be surprised. I knew it was
Yeah.
pretty low.
Well, this is something we talk about all the time that, okay, they're having a banner year, but you can't get investors to
Get
necessarily
excited. The
care
flows
about
just
that.
aren't
Because they're not having a banner year where large caps are suffering.
Right.
Yes.
Like they need to have like a regime change of a couple years, I think, before anybody cares. It's tough. Small caps.
Can't get no respect.
Just like this quiz.
How's your ego, Eric?
I'm fine. My ego is pretty beaten up over the
Impenetrable?
last 20
Okay.
years.
Oh,
Yeah.
okay. All right.
I'm married.
There you go.
All right, well, of course, we've got more games at Bloomberg.com pointed. You can play our news quiz where you can play around with things like leverages. And then, of course, go to QuizGo on the terminal, and you can play the terminal news quiz as well.
How long does it take for you guys to come up with these questions?
I do a lot of the work myself, and then I check it off of Eric's team, read through a lot of Bloomberg intelligence notes, or go dumpster diving through whatever I can
The
find.
trick
in
is my
Bloomberg
team wants to
News.
find stuff that I won't get.
Yeah.
That it's tricky. It's
But
an
then
art to it.
we also want to make it appealing for both of you,
Right.
So it's got to do a little bit of both.
All right, guys, that does it for us. Our thanks to Bloomberg's Joel Weber. This is Bloomberg.